Britain's biggest supermarket, Tesco, is reporting to the city this Friday, and expectations are for Tesco to report a growth of around 2%. But fierce competition remains in the sector. We've got James Bevan of CCLA joining me now for more on what to expect. So we've got the Aldis and the Lidls as well. Fierce competition. Absolutely
a challenge to all of the supermarkets where the shopper is very keen on price, and this was a major development that Tesco and Sainsbury in years gone by didn't really appreciate was going to happen to them. And they have, to be fair, responded well. So, for example, over the last 3 weeks, the Tesco shopping trolley has been cheaper than the Asda shopping trolley, and that is an unrecognised reality as to how Tesco is now competing for business. And I do think, therefore, they will report reasonable like-for-like sales in their first quarter announcement, and equally I do anticipate that they will be successful because they are using their scale to drive margin, and that is an important defence point for them.
And when will inflation, rising inflation here in the UK, when will that eat into their balance sheets?
It's already doing so, because what we are observing is the price of imported goods leading to a reduction in margin because shoppers are not yet prepared to pay higher prices. So the prices remain constant, the cost of delivery are going up, and therefore there is a squeeze in the middle. And that is a really difficult challenge for Tesco. However, if you look at the profit and loss account for Tesco, around 20% of their earnings before interest and tax come from outside of the UK. So the relative weakness of the pound actually will lead to a translation benefit for them, unlike the purely domestic UK supermarkets.
Other than price, how can Tesco compete?
Price is, I think, going to be the only real source of competitive success. They have tried being bigger, and actually it's got them into trouble because people do not want to go and buy everything from Tesco. And a lot of what they have introduced has been margin destructive rather than creative. They've got a very large physical footprint. They don't need to grow it anymore. What they have to do is to use the strength that is provided courtesy of that physical footprint to drive better deals with suppliers. And I think that's going to be key. Cutting staff costs is a really difficult challenge. 10% of the big supermarkets, traditional supermarkets, cost line is labour costs. It's about 7% in the discounters, and that 3% difference is a huge cost drag. Now, will Tesco say, actually, we're going to go further down the route of automation and reduce staff numbers to try and close the gap? Or will they say, actually, we're going to have a higher service proposition because we think people want choice and we want breadth? And if you think about the number of lines of stock, a big supermarket stocks around 24,000 lines. That is a heady multiple of the amount that you can get in a Lidl or an Aldi. The real challenge, I think, for investors is going to be determining what will be the dividend from Tesco going forward and how much dividend growth there will be. Because this is a company that realistically is ex-growth. In other words, we're not going to see an explosion of demand for high street grocery provision or out of town even. We have to see where it's going to go in terms of delivering shareholder value, and we have to see also how they're going to get on with online, which is going to clearly be an increasing challenge as Amazon says it wants to be much, much bigger in home delivery of green groceries.
Yeah. All right, James Bevan, we'll leave it there.
Thank you.
Thank you very much. We were talking about Tesco today, and every little helps.